Episode 22. There are 22 bones in the human skull. 1922 was the first year that insulin was used as treatment. I was 22 years old when I started medical school at the University of British Columbia. And 22 is quite a polarizing number in sports. You've got the skill of Emmitt Smith and Clyde Drexler, all the way to the douchebaggery of Claude Lemieux. Beyond MD, episode 22, here we go! Hey everyone, and welcome back to the Beyond MD podcast. I just want to take a quick second right now just to thank each and every one of you who took the time to listen to my first solo episode, which was episode number 21. It's really hard to put this in words, but I had a lot of support, a lot of messages coming in after that episode. And for me, it was a very heartwarming experience. And this is what makes the podcast honestly so meaningful and worthwhile for me. The fact that people are listening and hopefully benefiting and then reaching out to me. And just as an example, I'll read a quick message that came in after the episode. This one is from Amr, who said, "Just heard episode 21 and really appreciate hearing about your experiences. And in the spirit of networking and maintaining relationships, I thought I'd drop you a line. Wishing you and the family a happy new year and continued success this year. Can't wait to hear future episodes and appreciate all that you do." Amr, I love this message. It's very, very thoughtful of you, but I also love the fact that you acknowledge the importance of staying in touch with people and acknowledging the importance of relationships. And while this is a financial literacy podcast, I'll be the first to acknowledge that money does not buy happiness. Money can make happiness easier, but I'm a big believer that true happiness comes from your experiences and most importantly, your relationships with people around you. So let's keep that in mind as we all move along in 2022. So today's episode is on evidence-based investing. But before we get into the episode, I just want to make one thing clear. I really do believe that personal finance is so much more than investing. I think the most important things are in fact your goals, how to optimize your savings rate, being on the same page as your partner, establishing a plan and sticking to that plan, and then working on things like your financial plan and tax efficiency. But the reason I wanted to have today's episode is because when I started investing in 2018, I didn't understand how much evidence there already was to back up a sound investment approach. So why is it so hard to beat the market? Why is diversification so important? What is factor investing and does it have a role? And what is the importance of having uncorrelated returns in your portfolio? So these are all questions that I hope to answer today, and I'm going to do so with the help of John Stocking, who is a financial planner, chartered investment manager, and certified international wealth manager with 17 years of experience in banking and private wealth management in both Canada and internationally. John has been supporting his spouse, Shannon, through her journey to become a surgeon, from Vancouver to Sydney, Australia to Winnipeg, and now to their permanent home in Toronto. His educational background is in science, and as you'll see, he's taken to applying the same evidentiary standards to personal finance. And more recently, John started his own independent financial advice firm, Evidence-Based Finance, where you can get financial planning or do-it-yourself coaching or comprehensive wealth management, or all of the above on a flat fee only basis, which is very unique in the industry, and you can learn more about what John does at evidencebasedfinance.ca. Now, all conflicts of interest must be acknowledged, so John Stocking is a financial planner, but as you will see, there is no sales pitch here. Today's episode is about education. And with that, here's my interview with John Stocking. All right, John, welcome to the podcast. Where does the podcast find you?
Podcast finds me in the home office of Evidence-Based Finance on the west end of Toronto.
That's awesome, man. And you know what? Before we get into the finance, I just have to ask you about your golf trip to Bandon Dunes. Tell me about it.
Yeah. Well, friends and I have made a regular trip to this place. It's really like a golf mecca in Southern Oregon called Bandon Dunes. We'd been going for a few years. It got put on pause and delayed a couple of times due to COVID. Yeah. But the seas parted, and in November, the land borders opened and we were able to travel and the vaccines all worked out. So I flew to Vancouver and went with 3 friends. We drove 10 hours south and played 5 courses in 5 days. Wow. Yeah, it's pretty incredible. It's and it's 5 of the top 15 publicly available courses in the country. So and frankly, we got the best weather we could possibly ask for
That's
at an
amazing.
incredible cheap price.
So 5 courses in 5 days. So John, I played 5 rounds total the whole year, which was 2 more than last year. So we're trending in the right direction. Anyways, how was your game, by the way, Bandon?
I'd been practicing a lot because
Yeah.
the guys I play with are in Vancouver and they get to play a ton. So
Oh yeah, you got to keep up then. Yeah.
yeah, it was tough. But, I ended up playing pretty consistently in the mid 80s, which is great for me.
Good, man.
And really, more than anything, you just enjoy the company, enjoy being with friends, and a little bit of time away. I've been really trapped in my basement for the better part of 2 years.
I hear you.
And just loved it to death and had a blast.
Awesome, man. So we know that you're an avid golfer. Maybe just tell us a bit more about yourself and your background as it pertains to finance and investing.
So I am a financial advisor. I'm a chartered investment manager, financial planner, certified international wealth manager, whole bunch of designations. But my background, actually, I did my degree in biology in BC, concentrating on genetics and evolution. That's actually where I met my wife.
Mm.
Clearly, I didn't put my degree to good use. She did. She went on to medical school. She got into medical school in Sydney, and I had to find something that was transferable kind of across the globe. And I entered into finance, started working with RBC, and then when we moved to Sydney, I started up with a private wealth firm there. She finished medical school and we traveled back. She matched to general surgery in Winnipeg. I'd never experienced a prairie winter in my life.
So you went from Sydney, Australia to Winnipeg?
Yeah. It's even worse than that. Like, our apartment was like right on the harbor. My commute to work was walking across Sydney Harbor Bridge every morning with the Opera House on one side to Winnipeg. And I mean, Winnipeg gets a bad rap. There's a lot of great people. I learned a ton there and had a great time, but the winters are brutal, and I'd never experienced a prairie winter in my life. I remember the first winter we were there, the parking meters froze up in November because it got so cold so quick. And it just didn't warm up until like April. I remember most of the years our last snow was the beginning of May.
Oh my God.
But while there, I started up with a private wealth firm at BMO Nesbitt Burns, and moved over to CIBC and CIBC Private Wealth, and really started getting into the private wealth arena in Canada.
Very, very cool. John, I really want to ask you a quick thing about Australia. I find that interesting because you at least got a sense of how investing in the financial world was operating there. Because in Canada, we are kind of known to have high fees if you're investing in like an active fund. And I'm just wondering, kind of, how did Australia compare to us? Were they on the same level when it came to fees? Were they cheaper? Were they worse? Just curious.
I think Australia, although it's a smaller country and an island unto itself, they're very innovative, and I found that they were ahead of us in a lot of things. And so it was still 2008, 2009 when we were there. So a lot of the world hadn't really caught on to evidence-based investing, that sort of thing. But all the while, I think most of the friends that I still keep in touch with, it kind of moved towards the evidence-based side.
Awesome. So, John, maybe let's just start off with just the basics of investing, and then we'll dive into the investing factors. So, just talk us through it. When we talk about risk and returns, maybe just help us understand how risk drives returns.
Sure. I think with all of this, you kind of have to start with almost the history of evidence-based investing, which is the entire basis is in the efficient market hypothesis. This is generally credited to Eugene Fama. It's a theory that basically says stock prices reflect all the available information. The takeaway for us as investors is that there's no way to consistently beat the market if prices reflect all the information available. That's the first thing. But stock prices do change, and so we want to know why they change. And that has more to do with models that people develop, risk-based models. And so the first is the capital asset pricing model, which really explains why you should get a certain amount of return for a level of risk that you take. So if you're an investor and you just invest in a broad market ETF that buys the entire Canadian market, and that Canadian market returns 10%, you should expect 10% return. But if you're an investor who invests in 10 stocks and you take on a lot more risk, that you should be compensated for that risk. And so there's a way to measure that through the capital asset pricing model, what that risk is. And that's called beta. So what beta does is it informs investors how much return we should expect for risk. And if we're not getting that level of return, we're not really getting value for what we're doing.
Got it. And so maybe, we hear about diversification a lot. And so just help us understand how diversification can maybe increase risk-adjusted returns.
Well, yeah, the efficient market is the most diverse thing that we can have. So you buy the entire U.S. market, you have a completely diverse U.S. portfolio, and you're not taking any what we'd call idiosyncratic risk. You don't have higher levels of single stocks, and so you tend to do the same level as the market, and that minimizes this diversifiable risk, which is what you're talking about. And that's really an efficient portfolio. And really, when you think about it logically, on the global market, $650 billion gets traded every single day by literal rocket scientists who are putting computers as close to the exchanges as possible in order to integrate information that's becoming available. So what we don't want to really be doing based on the evidence is guessing at which parts of the market, which stocks, which specific areas might be outperforming going forward, because the smartest people in the world have already taken that information and integrated it.
Perfect. So I think that goes into my next question. I was going to ask you to tell me, why is the alpha, why is that so hard? And maybe you can just define alpha for us too. I want to make sure listeners are all on the same page.
Right. So we've talked about beta, which is really just the amount of return you should get based on risk. And then alpha is a measure of the excess return you get on a risk-adjusted basis from an active manager. So if a manager wants to make money for you, they have to outperform their expected return plus their fees. So that's all alpha is if you expect based on your beta to get 15% return, right? And your portfolio manager gets 17% return, well, he's produced a bit of alpha there, right? You've earned more than your risk-adjusted basis. I think the biggest takeaway that we can really get from alpha is that it's very, very hard to capture, and it's very, very hard to do consistently. Standard & Poor's issues a report every year on active managers and how they do. And really most don't even outperform the basic benchmark. So not only do they not outperform their risk-adjusted return, they don't outperform just the market on its own, much less their risk-adjusted return plus their fees, which in Canada, we pay the largest amount of fees really anywhere, which tends to be about 1.8% or so.
Yeah, okay, that is high. So, John, getting into the factors now slowly. So you talked about the efficient market hypothesis, but I guess from my reading, in terms of the explanatory power of that model alone, like if you took two diversified portfolios, it sounds like the efficient market hypothesis, could explain the differences in returns between two diversified portfolios to some extent, but not completely. And so I guess that's where maybe these additional factors come in. So maybe I'll let you kind of take the lead here and just kind of summarize the factors and factor investing for us.
Well, in a way, the way I view it is the efficient market hypothesis tells us why prices are where they're at. It's kind of a theoretical idea. In order to make any predictable hypothesis out of it, you have to have a model built into it that says, here's what prices should be. The first of those was the capital asset pricing model, which kind of told us what beta was. And actually, the capital asset pricing model gave us the first factor, the market factor. Yep. It told us that if you invest in stocks over a period of time, a broadly diverse basket, you should get a certain percentage of return for taking that additional risk relative to what you get for just, say, owning cash. So maybe cash, you get 2%. For owning stocks, maybe you own 7. The difference between them is that risk premium, and that's the factor. So the first and probably the most important factor is the market. And that's what most people are invested in. They're getting into broad-based ETFs, owning really nothing else. And so they have pure exposure to the market factor. As people tested the capital asset pricing model with empirical data, they found over time there were a lot of anomalies actually in the capital asset pricing model, really only explained about 70% of diversified portfolio returns.
Okay.
So some of the early anomalies that were discovered, work done by Dr. Eugene Fama and Ken French, found that small companies and companies that were considered cheap actually generated return in excess of what the capital asset pricing model would say they should get on a risk-adjusted basis. They found that companies with these specific types of characteristics could do better than what the capital asset pricing model explained. French and Fama went on to build the Fama-French 3-factor model, which includes the market, small cap stocks, and value. And they found that it better explains diversified portfolios and now explains closer to 90% of the return. And that's kind of the first initial factors that we've run into.
And just to summarize, the 3-factor model, so that incorporates the market factor, smaller companies, and then value. And then so if we kind of take that and expand that a bit to the 5-factor model, what are the additional 2 factors that we take into account?
And this is the great thing about the science of finance.
Yeah.
They found these other factors that worked, but that wasn't it. Like, they kept going and found, to your point, other factors that they've incorporated, profitability being one. They've found on top of that investment, so aggressive versus conservative investment in the companies, to be another factor. Other factors that have come up along the way. There's thousands of factors that have come up since, but those are the 5 main ones in the Fama-French 5-factor model. On top of that, they built in something called momentum.
Interesting. So momentum, I was going to ask you about, John, like within the academic community, things like momentum stocks and low volatility stocks, like, are those also incorporated into models, and are those also felt to, I guess, be important when it comes to predicting returns between portfolios?
Certainly, momentum comes up a lot. And it seems pretty clear that it's a factor that impacts returns. The problem with momentum in particular is that it's notoriously hard to efficiently capture. So it's certainly sensible, it's persistent, it's pervasive. The problem is that it's not very cost efficient. It involves a high level of trading to capture momentum. And so it's really hard to use as a factor unto itself. With other factors that have come up, to be able to use it as an everyday investor, they do have to pass the muster with 5 really stringent considerations. They have to be sensible, so they have to make sense.
Yeah.
They have to be persistent over time. They have to be pervasive. So once you figure out or find something, a characteristic that works and provides additional return, you have to test that against other types outside of your sample. So you go and test. If you found it in the US data, you'd want to go out and test it internationally, emerging markets in Canada, that sort of thing. It has to be robust, so the factor has to be big enough that it makes sense, and it has to be cost effective. Something like momentum meets almost all of those except for the cost effectiveness. And you find that it does get implemented into modern academic portfolios, but it's more used as a screen, where they won't sell something that's been going up for a while just because it might continue to go up, or they may not buy something that's been going down for a while because it continued to go down.
So factor investing does seem to be backed up by evidence. But one thing I do want to touch on now is that essentially since 2007, so we're looking at basically 15 years, in that time frame, growth has absolutely trounced value. And the gap has been quite shocking. I mean, it's only recently been starting to change. But when you go back into history and you look at even the better part of the 20th century, there were 5-year segments where growth maybe outperformed value, but it stopped there. Now we're in a segment of time that's 15 years. And so My question to you, John, is what has fundamentally changed? Is it our reliance and belief in technology and the way technology essentially shapes our everyday life? Is it herd mentality, the fear of missing out? Is it more day trading that happens now, or maybe a combination of all these factors? Like, what has fundamentally changed in your mind?
Yeah, is the factor broken, right?
Yeah, you wonder, right? Because you go back into history, and for most 10-year segments, value is outperforming growth. But then here we are in a 15-year stretch where growth has vastly outperformed value, and only recently has it been starting to change. So I think the recent events make you think, no, the factor is not broken, but this is what I'd love your take on.
Whether it's working or not, I mean, you have to look at what's happening to say whether it makes sense, right? There's been other dry spells, particularly going into the tech bubble and the one obviously we're experiencing now. But factors can then outperform for extended periods of time, right?
Hmm.
Um, I think for me, the thing is, does the underperformance over this last little while make sense? And I think the wrapper that I put around it is that we're definitely going through a technological industrial revolution. We have been for almost 2 decades now, right? Since the tech bubble burst. It's changed the way that every single business does its business, how every single person throughout the world goes through their daily lives. And there's going to be some survival and growth of some very large companies. And this is pretty common in industrial revolutions, and they tend to grow massively over that period. So this large cap growth is really plain to see in companies like Facebook and Amazon and Google and Apple,
Hmm.
Microsoft. On top of that, they've had cheap money. Interest rates
Yeah,
have started
that's a
to
good point.
decline to historically
Yeah.
low numbers, and so there's been in some way or another an influx of funds into the system, and that those funds had to go somewhere. We've got the baby boomers accumulating a lot of wealth, and that money going somewhere. And in combination with that, I think you add a bit of behavioral bias.
Hmm.
There's been a swing by investors towards ESG friendly companies. It's
Yeah.
been a very large trend over the last 5 to 10 years. For me, that disproportionately favors a number of these large cap growth companies like Amazon or Apple or Microsoft or Tesla, because they're not the unfriendly oil and gas or mining companies. So that money
Right.
has to go somewhere. The other part of that might be a more of a behavioral finance thing too, which is people tend to pay a bit too much for growth and too little for value. We overestimate high odds and underestimate low odds. So that's more a everyday investor idea. But I think all of those things mean to me that it makes sense. And it's not just a single value metric that isn't working out. People are paying more, not just on like book value, but also on cash flow and even on future expected earnings. You have to think
Yeah.
about that. Like,
Yeah.
knowing their predicted future earnings, the average investor is now paying more for the exact same future dollar earned.
Yeah.
That story then means to me that value really isn't broken. It just means that we're willing to pay a bit. There's more money in the system, and we're willing to pay a bit more for that future growth.
All right. So when it comes to incorporating value into the portfolio, there are clearly different ways to do this. So for fun, I was looking at one value ETF. The ticker is VLUE. Now, this is certainly not an ETF that weights the holdings by market cap, but you look at the top 5 holdings, you've got things like AT&T, Intel, Cisco, Ford, and IBM. And certainly these companies don't appear to be best in brand. And I know that's sometimes the case with value investing. But for example, when I compare IBM to Microsoft, I just don't feel like holding IBM. But then when I go to some other ETF holdings, so some of the ones by Avantis, I think the ticker is AVUV. You've got small cap value, profitable companies, maybe a bit more intriguing there. So, John, maybe just talk to us about why it's important to do our due diligence when we're figuring out which ETFs to incorporate into our portfolio, and what's maybe a reasonable way to incorporate value into the portfolio.
Sure, yeah, and it's a really good question, right? How does your everyday investor get into this? And I've reviewed some of the value factor type ETFs available to Canadians, and like you, found them maybe a bit lacking. Due diligence is tough to do for the average person. It's hard to know what you're looking for, how to isolate for it, and then how to apply it. I didn't like value necessarily, but not for the same reasons that you did. Value investing by its nature tends to hold companies that are out of favor, like AT&T or Ford or IBM. And a true value tilted portfolio isn't going to let go of the large cap growth. I should make that really clear. Most of the overall portfolios that I see still hold RBC and Apple and Microsoft in their top 10 holdings. They just have disproportionately higher value, small cap value profitability companies. So the reason that I didn't really like VLUE isn't because of its holdings. It's because when I look at it through a filter, it doesn't really give us a statistically significant weighting towards the value tilts that we want. So as a bolt-on to your existing portfolio, probably doesn't give you enough and an efficient amount of small cap value, to your point. For me, what I look at, it's an American website, but it's called Portfolio Visualizer. It's kind of the best tool to use to identify factor exposures, but it's only available for U.S. funds and ETFs.
Yeah, gotcha.
So, I mean, just looking at the name isn't really doesn't really mean a lot for what you're buying. There's no standard that has to be met to name yourself a value fund, and there's a lot of ways to potentially capture some value. So the first step is to make sure that they're capturing the value that they're claiming. Then review the MERs, make sure you're not paying an excessive cost. And then finally, with the academic type factors, as I mentioned earlier, there could be additional costs that you don't really see, like trading costs. And you want to make sure that you're not getting a high turnover rate within these ETFs just because they're chasing academically true factors.
Right.
But you could lose the premium, the amount of excess return you should get from the factor, by losing out in management expenses and trading costs. You did mention AVUV, the Avantis group of funds.
Yeah.
I wanted to touch on that for sure. These were created by a crew of people that left a company called Dimensional Fund Advisors.
Okay.
It's really steeped in the academics behind it, and Dimensional Fund Advisors has been around for decades doing this sort of thing. So they're well versed in the theory. They have really obvious factor exposure. They're relatively low cost, and for those reasons, the Avantis group of funds is really a nice bolt-on to a portfolio that would give you some really good factor exposure. Problem is it's in US dollars and traded on the US market. So it's a little hard for Canadians to get access to.
All good points, John. Thank you. So the paper I read recently, that was Ben Felix's paper, which I think he published in 2020. And kind of towards the end of the paper, he had a very compelling graph that basically showed the kind of upside and downside of each factor over time. I think it was from 1963 to 2020. But the most remarkable thing about that graph, was that the overperformance of the various factors was typically happening at different time frames. So, when you've got, maybe the high profitability kind of underperforming, you've got maybe small cap or value overperforming. And so when I kind of look at that, you have these different elements of risk in your portfolio if you're going this route. In addition to kind of higher risk adjusted returns, do you feel like this also offers some downside protection? Because, sometimes I think downside protection is important, but some people say, you know what, it's a bit of an illusion, doesn't really matter, it's irrelevant. I'm just curious, do you think incorporating factors does offer downside protection as well?
Downside protection, the way it's explained traditionally through active management, is a bit of an illusion. It doesn't seem that there's much good evidence for that. I think Ben's paper is really interesting, and the observation you're making here is really interesting. And part of the reason that factor investing is so attractive, people hear factor and think risk. And while the FEMA French factors are a risk story built on the efficient market hypothesis, we really need to define how that risk works. It's not cumulative necessarily. These risks, these factors, these characteristics are uncorrelated from the market return, which is the point that you kind of made, right? So they show up at different times, and the result of that is very similar to why we have modern portfolio theory. You own stocks and cash and bonds and other assets because they have performance that's uncorrelated, and that results in a smoother overall return. And we see this every single day in the portfolios that I present, because while you're capturing some additional return using factor investing, what you're finding is you're getting 1 or 2% more return, but the standard deviation, the measure of risk, the variation of returns, is effectively the exact same as a broad-based ETF portfolio. So with the concept as you're presenting it, I think is really important, not necessarily for somebody who's accumulating funds. I don't know that it makes a huge difference there. I think this concept is really important if it continues for folks who are nearing or entering retirement and having some decumulation, because the biggest issue is that how they experience returns in retirement. If they draw down assets in a negative market, that has a real substantial effect on their overall portfolio. And so we can find in the empirical data, the worst time to retire in the US was December 1963 and from then until January 1984, the US market trailed cash. So it returned less than just owning cash by about 0.4%. That's insane to think.
Yeah.
Nobody tells us that the market is broken, right? We don't really hear that now.
Right.
But for the better part of, what is that, like 16 years?
100%.
The market did not have any return relative to cash. You would have been better off just stuffing your money into a GIC than investing in the biggest companies in the world. So that's 15 years of compounding where investors would have been better off holding cash. Over that same time, the FAMA French US Value Research Index returned about 6% better than the risk-free rate. So its returns started to show up when the market factor wasn't doing that. And that's an isolation, but it's shown up before too. So they had similar findings in Japan from 1990 to present.
Yeah,
last
totally.
29 years, let's say. The FAMA French value factors outperformed by 3 to 5% per year over that entire stretch of 30 years. It's insane, right?
Yeah.
I'll add on to that just to beat the dead horse, so to say. Over the 111 rolling 10-year periods from 1973 to 2020 in the U.S., where the U.S. market premium was negative, the small value profitability investment premiums were generally positive, small being the one that was less so, but the other ones were. So I do think that that's really important. You want to have these uncorrelated risks and uncorrelated returns happening to smooth out your return and make sure that you're making money. So I think one of Ben's big conclusions there was that potentially it's more important to hold diversified risks, so these factors, than it is geographically. I mean, I can't draw that same conclusion, but given how pervasive the data seems to be and how well other market factors have performed, I think it makes sense to at least have some exposure to these factors. Yeah.
John, I think that's phenomenal. I was going to go through some segments of this paper, but you've captured all of this really, really nicely. Now, one thing I do want to hit home is when you're investing in the factors, you're essentially diversifying across different types of risk. But these are not bad risks to be taking, right? Because sometimes I feel like it's easier for us to wrap our head around this concept of factors when we talk about them as different characteristics.
Right. I mean, it's a risk-based story, but these are characteristics, right?
Yeah.
You own small cap value companies. You own companies that have more profitability. It doesn't feel like a risk. The profitability factor, if you have a more highly profitable company, that's going to outperform over time. That's one of the factors. Conservative investment within the company over aggressive investment is going to outperform over time. So yeah, these risks, while they're called risks, they can be called characteristics. But again, due to their lack of correlation to the main risk, which is the market factor, they actually smooth things out. They don't add on to each other, and they're not additive.
Now, I just want to highlight a quick scenario. So I was talking to somebody recently who told me they were investing in the factors, but that it didn't work. It essentially flopped. And I asked them, how long have you been investing for? And they said just a couple years. But when you look at the evidence for the factors to basically offer their uncorrelated returns, this is a longer term phenomenon, right? Like you have to be thinking the long game.
All investing is a long-term phenomenon, right? And I think as humans, we have this bias that we kind of chase returns and we don't want to see our peers doing better than us. And so we stop following the discipline. If you understand what factors are truly, and you've looked at the evidence and seen how persistent and pervasive it is, I think it's an easy discipline to follow, but like anything, humans have our own biases and it's very tough to maintain.
Absolutely. Now, John, a lot of people listening to the podcast are in healthcare, and in healthcare, we tend to practice evidence based medicine. So we're very in tune with the evidence around us. And I would think that many people would want to follow an evidence based investing approach. But then again, like a lot of people out there, we're very busy and we want to leave things on autopilot and simplify things at times. So for the average kind of DIY investor, what's your suggestion? Like, is it just put your money in kind of an index fund, or should you actually take the time and effort to incorporate factors into your investing approach? Any thoughts there?
For the average investor, and I think I want to make that clear. What is your average DIY investor? My experience, and maybe yours as well, is informed through a large Facebook group that we're both part of. But
Yeah.
the average investor there, I don't want to say this in any sort of way to insult people, but I don't think they're incredibly overly sophisticated. They're not looking deep into the evidence. They're seeing that there's a very simple way to maintain a good level of return without taking an excess of fees, and by default, that's going to do better than most Canadians. If you tack on factors, yes, you have the potential to add 1, 2, maybe 3 more percent over time. But the factors are hard to capture. They're notoriously hard to capture. They involve a lot of discipline. And so, do I think the average investor should be doing it? I'd probably lean more towards no. I think a more sophisticated do-it-yourself investor could certainly do this. I think factor investing is great for someone like me, an advisor, where we basically act as a personal trainer.
Mhm.
As anybody who's tried to stay fit knows, it's really hard to stay on track when you're not seeing results or when things get tough. And so I try to act as a personal trainer, and I imagine other people would, where we don't really care how you feel. We're just going to keep staying with the discipline because we
Yeah.
know over time it's going to work out. I think it's important for people to incorporate and know about, but like your friend that you were talking to, the moment that they try to invest in a factor and then give up on it, they've just blown out any potential return that they would have had, right? They
Yeah.
invested in something that isn't performing over a reasonable period of time. And the moment, inevitably, that they divest themselves of it, those factors will show up. So you really have to stay disciplined, and it's really hard for us to do that unless we know really well what's going on with these factors in the evidence.
Perfect. I think this is a really good kind of segue into evidence-based finance, which you started. So, John, tell us more about evidence-based finance, what it is, and kind of why you started it.
This has been a passion project of mine. I've been developing the ideas of evidence-based finance for a number of years and thinking about how to provide financial services to people, but in a more reasonable manner. I felt like for a long time, the interests of the financial institutions, the people who employ advisors, and the interests of the clients are kind of running up against each other. And myself and other advisors are put in between those interests. When I was at a bank, it was hard push to sell more stuff. When you're doing portfolio management, it's a push to have people and more managed products and make them sticky and get a lot of fees out of them. Never once in the first decade or so that I was in finance did I ever hear about what the evidence is. And it's taken my own curiosity, my own need to prove what I believe wrong to get to this point. Recently, my spouse transitioned from being a trainee to staff, and
Mhm.
that gave me the opportunity to take on what I think is a pretty substantial risk and go out building my own business in finance that is unlike anything else that's out there. It took a bit of time. I didn't start with any clients. I didn't have any commitments, and I had no portfolio to begin with. And what I've done is really tried to build something that gives people evidence-based, good financial advice and doesn't come at their expense. There's a reasonable cost to doing things. I think I have value that I add, but I don't think people should be employing me at the cost of their own future. So that's what I did. I went out and built a company.
That's amazing. I mean, great for you for taking the initiative to do that, John. And obviously, we've talked about a lot today. The evidence points to investing in ETFs for sure. And even if you want to take it one step further, investing using the factors. And you've already kind of touched on this, but I want to give you a chance. The average person, if they follow the evidence, they should just be able to go and do this themselves. Invest in ETFs, maybe incorporate the factors. What I want to know is what is the value that you can bring to the table for people who want to maybe take it to the next step and just get a bit of assistance.
Pretty common question. If investing has been commoditized, if you can just buy an ETF, short of factor investing, where I think I add value, especially in Canada, where it's much harder to get access to that. As advisors, we need to be very clear on what our value is, where we can add value. Mm-hmm. Part of what I do, a huge part of what I do, is financial planning. And every financial plan I've done, maybe save one in the last however long, I've saved or made people tens of thousands to hundreds of thousands of dollars a year in one instance in fees, and made more in investing by giving them a very clear path. I think what we can do is creating a plan gives people a reason to follow and make the purchases of the ETFs that they make, right? It's all well and good to know that you should invest in VGrow. It's more important to know where you should invest at, whether it's the RSP or the TFSA or in your corporation, and why you're investing there in order to maintain the discipline that you're doing. So planning is a big part of things. Understanding generally like taxation, estate planning, portfolio management. These are all things that I can add value for. Managing personal biases, I think, is a really, really big one. There's folks all over the place who have heard certain things, do things a certain way, and unless they're hearing the actual evidence and it's being shown to them why they should be doing something other than that, they're generally going to follow that. So they need an outside view to check these personal biases. I think we offer as advisors a huge amount of value.
Yeah, John, and I really like how you called it evidence-based finance and I like that you're hitting on all the points that there's more than just investing to it. Certainly there's a planning component. And when I look at the big picture, I really do believe a lot of the important stuff is, in fact, outside investing. So it's nice to hear that you're capturing all of that. And just correct me if I'm wrong. So your service that you offer, it is essentially a flat fee type of service, right?
Yeah. And this is, I think, what makes what I do kind of unique is I do flat fee, just financial planning. So that I'll do a comprehensive plan for anybody, even if they don't invest through me, which is highly unusual for anybody who manages investments. And then I do coaching. So I'll do it-yourself coaching there's loads and loads of people. This kind of got incorporated into the business late because a good friend of mine had mentioned, she talked to loads and loads of folk who have said, well, I'd like to do it. I don't have the brain space or the ability to do it myself. I'd love to have somebody there helping, coaching along the way, but I just don't trust anyone to be able to do that. Yeah. And then you've got the AUM fees that are always kind of a sticking point. So I created a flat fee evidence-based coaching where people can come to me. I get them. I do the full financial plan. I put them into what they do as do-it-yourself investors. I'd manage the money for them until such a time that they, working together, we've got them to a point where they're confident they can go out and do it themselves. And at that point, they can transfer out to their own direct investing platform the exact investments that we've got. I'll help them, and there's no cost. They move in kind. That's very unique for what I do. And then the investment management side of things, there's people who just don't want to do it or would rather spend their time that they could spend investing, doing other things, dedicated to family. My wife's a great example. She just wants nothing to do with finance whatsoever. Those people are the ones who end up spending the most amount on financial advice. I can't fathom somebody spending $50,000 a year, a 1% fee on a $5 million portfolio to get financial advice. I don't know that there's anything that we do that drives that on an annual basis. And so I've figured that doing the math and getting to where I want to get to in about a 5-year time frame, if I charge people a flat fee, it doesn't grow over time. You pay $7,000 a year. I will totally give you the private wealth management type experience where I manage everything. I make all the decisions for you. You get the financial planning. You get everything under the sun. You don't get this increasing cost. It's totally transparent. And what it does for me is it removes a conflict of interest as well. I'm not driven by saying you need to put your money in here, you need to do it this way. I can look at problems objectively and give people what I think is the best evidence.
John, I love it. I love it. And you know what, just to hear you also talk about the coaching aspect, because I think that helps people to kind of overcome behavioral biases that can play a big role, and also to help people understand the evidence. So I think it's a very kind of useful multi-pronged approach that you're using there. It's great to see. So John, last couple questions. A lot of people ask me, well, I'm debating whether or not I should seek out the help of a financial planner, but I just don't know if now is the right time for me. So, when might people find getting help from a financial planner useful? Like, some things I can kind of think of is if they want to do things maybe in a more tax efficient way, but they aren't sure. Some people maybe who are just starting out, wanting to get their feet wet, but they don't feel totally comfortable. And then other people may have a large sum of money coming their way, whether it's maybe a sale or an inheritance. I'm just wondering, when should we be maybe kind of seeking the assistance of a planner?
I don't think there's a bad time. Obviously, I'm very biased. I don't think there's a bad time to seek the advice of a planner. I think the most unlikely time is when people get into a very good rhythm. This tends to be, you're in your working years, you're just accumulating assets and they're going to the same spot year over year. Where I tend to do a lot of my work is with newer to practice. So starting out, figuring out what kind of income they should be driving, where they should be investing their money, why they should be investing it in certain spots, RSP versus TFSA versus retained earnings, whether they should incorporate. So those are some really big questions, and paying $3,000 for a plan to set you on the right path and inform all of your decisions going forward seems like a pretty reasonable idea. The other place that I tend to see a lot of folks is as they're starting to think about retirement, whether they have enough to be able to say, yes, I'm financially independent. Mm-hmm. We can go on our way and we'll be really comfortable. Then how best to draw down. So accumulating assets is quite straightforward. Decumulating can be a little bit of a different story. I even did a plan once for a fantastic couple. They're great folks, but they had done really well. They're still young folks and they'd done really well up to this point, but they wanted confirmation that they'll get to where they're going to get to and that they could really live life. So money for them had been something that they'd been saving and saving and saving. And, they weren't buying new cars and they weren't doing extravagant vacations. But with the trajectory that they were on, it seemed very clear that they should certainly be enjoying life a little bit more now rather than saving excess amounts. They weren't planning to retire particularly early. So they came to me to say, can we kind of unleash ourselves a little bit and do a little bit more spending along the way? I thought that was a great plan to do, frankly.
Yeah, you know what? There's so much to be said, John, I think, for living in the moment and making sure that you're enjoying life along the way, right? Because you don't want to be miserable and then enjoy it later when you're older. So, John, any questions that we should absolutely be asking somebody, like if we're seeking out a planner? Any advice there?
I think experience is a big one. So doing financial plans, it might seem on the face of it relatively simple and straightforward, but there's a lot that goes into it and a lot of assumptions that get done. The plans that I produce tend to be like a 10 to 12 page executive summary and like hundreds of pages of data. Simple errors in compounding can have massive effects. So you'd want somebody who's experienced, who's done a lot of plans, probably has a few designations, has learned along the way how to deal with certain things. False evidence is a big one. Mm-hmm. You never want to get captured. I've found of late that a lot of people who just do planning also do insurance sales, and their purpose for doing the plan is almost exclusively to sell insurance. So, be weary of that sort of thing. Yeah. And find somebody that you get along with. I think it was Daniel Kahneman who said, you want somebody who's your friend but doesn't care about your feelings. I want to say that I'm a good example of that. I generally really like the people that I work with. Yeah. They come to me, we have good rapport, we get along really well. But if you're doing something wrong, my first instinct is to always just tell it to you flat that this is the error. That's really going to help any sort of investor or any person getting along the way.
I think that's really important, John. And really last question I kind of want to ask you is, we've talked about the evidence behind ETFs, behind factors. It really seems like there's a mountain of evidence there to support it. And so even for somebody like me, I've been investing for 3+ years, and I feel like I'm getting more and more in tune with the evidence. I'm a medical professional. I tend to follow evidence in my day to day. But when it comes to investing, why is it so difficult to just stick to the evidence-based approach, an ETF? Like, why am I so eager to kind of look up the latest earnings reports and, try to look up profitability and growth of a company and try to pick the next stock? Like, why, I also bought a few crypto ETFs. Like, why do we find ourselves doing these things? Not to say that there's anything really wrong with it. I think everyone's got their own approach, but I do believe that myself, and I think a lot of other people out there would probably benefit from following the evidence. Why is it so hard to follow it?
It's a really good question. It's not surprising at the same time. I mean, the evidence is based on humans being rational. I think if there's one thing that we can say about humans, it's that we're pretty irrational. I think your answer for this falls into two categories. There's the group of people who deal with the major investment firms and the banks. I think that's the majority of Canadians. 88% of capital is still invested into active funds. This is clearly anti-evidence. And most of those people deal with the major banks. 80 to 90% of active funds is invested through the major financial institutions, and they obviously make more money doing that. So for this group, I think probably haven't seen the evidence, and active investing can kind of make a lot of sense, right? Really smart people should be able to pick out the best companies. You're a smart dude. You're a radiologist. Why can't you find the smart companies and avoid the dogs, and the resulting is outperformance, right? Even more so, why can't CFAs do this? We have banks who are meant to be great stewards of our money, employing the smartest people in finance in Canada, doing this sort of thing. Shouldn't they be getting outside performance? The other thing they claim is downside protection. They can switch when markets start to turn down. They can get out of these things and put it into something where you're not going to experience so much downside. I think the draw for a lot of people is that those claims make a lot of sense, and we trust the people who are telling us that. The evidence is pretty clear that they can't do that, nor do they do it particularly over the long term. So for those folks, I think it's, there's a fellow by the name of Dan Solon, who's an investor advocate in the U.S. I'm going to quote him directly here. He said, because you've got domination by the 5 major banks who have a lot of conflict of interest and have a lot of ability to cross-sell, instead of using that leverage for good, to a large extent, they use it to perpetuate the sale of actively managed, expensive products. I think we trust banks. There's a lack of information for what the evidence is. It's pretty clear for that portion of things. And there's a general naivety that plays into that group. They don't know what good evidence is, and it's sometimes very hard to follow. There may also be some confirmation bias in this because they've done so well over the last decade or so. Why do that? There's a second group here, maybe more like yourself. This might be speaking to you.
Yeah.
One, it's that we believe we're rational. Some people may have outperformed over the last little while investing on their own. So don't fix what ain't broke. But there's a guy by the name of Daniel Kahneman who's done a lot of work in this field. And, we trust experts. We trust our own intuition. We trust that good things will continue to happen due to our eternal optimism. And we overestimate our chances of success while underestimating the likelihood of the lower probability bad events happening. This is level 1 thinking, according to him. It's instinctive, it's emotional, it's easier for us to compute that way. And he's also written a lot about noise, probably something that you experience as a radiologist. There's tons of noise in what you do on a daily basis, right?
Absolutely. And there's a ton of noise. There's too much noise through my Yahoo Finance app too. I think that's part of the problem. You hear this noise and then you make these knee-jerk reactions because you feel like you have to do something. I'd probably be better off if I just turned the app off, to be honest.
Probably. There's just so much financial information in our world. And we need to train ourselves to have good filters to know when something is frankly bullshit and when it might be relevant.
Yeah.
And once we find out if it's relevant, then you have to do what your medical training's done. You need to have an algorithm to integrate it, decide if it's useful, and then be able to act on it. This is what Kahneman would call level 2 thinking. It's slower, it's deliberative, it's more logical, but it's also harder. It burns a lot of energy, and we tend to avoid it. So those are the two groups that I think it would fall into, and why maybe they do it. What I think you could take away from this, and again, what Kahneman says, what can you do is don't trust people, trust the algorithms. So remove the decision making from yourself or an advisor. Take the broad view. So, you find this stock that has great profitability. Don't look at that in isolation. See it as less than binary. It fits into an entire class of decisions of how you're building an evidence-based portfolio and how it might impact that. One of the big ones maybe lately is to check your regret. There's a lot of FOMO. Getting into crypto is a great one. Not buying the meme stocks is another one. People who experience regret and are trading on the basis of that tend to trade a lot. They tend to sell at the wrong time, and they tend to buy when prices are high. And then the last thing that Kahneman says you should do is seek out good advice. And I kind of touched on this earlier. You want an advisor who likes you but doesn't care about your feelings. That's it.
John, I think that's a great answer. And for me, I started investing just over 3 years ago. But when I started, I didn't know that there was already so much evidence to kind of steer us in the right direction. And so for me, it took me some time to really wrap my head around it and get in tune with it. And now, after multiple exposures, I think it's definitely hitting home for me. So my hope is that just by getting the word out, I think that the evidence will hopefully start to have a positive impact on more people out there who are investing, whether it's DIY or with a planner or advisor. And that's why I wanted to have you on, because I know it's an approach that you embrace, which I respect. And I just want to thank you, man, for taking the time.
Yeah. And thanks so much for having me on and giving me this time to talk about what I do.
Yeah, it's a pleasure. And let's hope for an early start to spring, and the fairways will be waiting for us.
Greener pastures.
Take care, man.
Thanks.
All right, guys, there it is. Evidence-based investing. Now remember, I'm only here to present information. I don't tell anybody what they should be doing. People can do as they please. But I do think that for most people, many people I should say, including myself, I think ETFs are a pretty good way to go. I have said that I hold several stocks in my portfolios, but what I am trying to do with time is get to a point where I'm about 50% ETF. So I'm getting there slowly but surely. And for reading material, I will attach 2 papers. The first one is called Our Approach to Building Portfolios from Wealthsimple. Now, it is a white paper, and I'm not telling people that they should invest with Wealthsimple, and I'm not saying that I necessarily advocate their approach, but I do think this paper is a really good review of the basics, and it does cover a bit of information on bonds, which can be not so easy to grasp at first glance. Again, not telling people with a longer horizon to go invest in bonds, but it's good to understand the basics. And the second paper is called 5-Factor Investing with ETFs, published by Benjamin Felix. This is a fantastic read. It may take 2 or 3 reads, as it did for me. Not something that you should be reading on the treadmill necessarily, but I think worth diving into to understand the factors. So guys, reach out to me anytime, beyondmdpodcast@gmail.com or on LinkedIn. I love to hear from you guys. Let me know how the investing journey is going. And we'll probably see you in about 3 weeks' time. And until then, stay safe and stay savvy.